Looks like financial conditions among South African households are starting to recover and credit demand is starting to pick up. Demand for credit by the private sector rose by 0.8% year-on-year last month after a decline of 0.9% in April. And while household debt remains high, it's improved slightly between the fourth quarter of last year and the first quarter of this year. Savings levels have also improved. Joining me to talk about credit demand and particularly mortgage credit and savings rates are John Loos, property strategist at FNB Home Loans, and Sheshi Kaniki, he's senior economist at Momentum. Gents, thanks for coming in. Sorry I mangled your name up there. I'll get it right in the outro. John, mortgage advances up 4% in May from 3.6% in April, and that's really driving credit demand at the moment, it looks like. Are households becoming more confident and starting to borrow again?
Yeah, Stephen, just a correction, that it looks like we had a lot of us economists had a problem with our data feeds this morning, and the mortgage numbers, actually there was a re-estimation of last year's May figure, so they didn't actually go up. They stayed very similar to levels for April. But nevertheless, if one looks at new mortgage borrowing, I think one mustn't get confused with the growth in the overall book. That's an interaction, that's the result of an interaction between new lending and capital repayments. If one looks at new lending and new loan grants, which is a good leading indicator, it's very much a residential story at the moment. For March, the SARB quarterly bulletin showed about 74% year-on-year growth in the value of new loan grants. There is double counting because more than one bank would grant on the same application. But that's in stark contrast to the commercial side, which for March was minus 40% odd. So very much a residential story, and yes, new lending growth has been recovering for quite some time.
And consumers really driving this, as you're saying, not commercial properties? No,
very much the household sector driving it. It's still, in terms of absolute rand value, still a lot lower than a few years ago in the boom times. Comes off a very low base after big declines in new borrowing or new lending last year. But yes, we have seen significant growth in new lending.
Well, Sheshi, you put out a paper saying that it shows an increase in savings as a percentage of GDP towards the end of last year. It's up at 15.8%, and that's the highest since 2003. Is it normal that we would increase savings during a recession? Because we were still coming out of a recession at that period.
I think there are good reasons for that, Stephen, and one of those reasons is simply that people are in an environment of greater uncertainty, and when you get uncertain about your situation, you tend to save for precautionary reasons. You're not sure exactly what's going to happen tomorrow. I think also the credit market became tighter, so credit, which is very much at the forefront in terms of helping our consumers spend, became tighter during the recession, and therefore from a household point of view, these combination of tighter credit conditions and people taking a much more cautious, conservative approach to spending saw household savings go up.
Well, as we see credit conditions being loosened, as we see the consumer getting back on his feet and the country coming out of a recession, do you think savings are going to fall again?
Well, actually, last week the Reserve Bank released its second quarterly bulletin for the year, and it actually shows that saving has already started to decline slightly. And one of the reasons for that is the fact that consumer spending is on the increase. So there is this, as we move into recession or as we move out of recession, there is this direction where saving goes in one direction and expenditure goes in the other. Clearly, we need both. We need good expenditure. We need strong consumer spending in order for the economy to keep growing. But at the same time, we also need a good savings culture, and we need a robust savings environment for sustained growth. So it's finding that balance between the two.
How do we find that balance, John? Would we rather just pump our money into our mortgage rather than putting it into the bank?
Well, for a country as a whole, I mean, it has been suggested by the IMF a few years ago that government do the saving on behalf of the household sector. That hasn't really been happening, though. Government saving is also pretty weak. So it's tough. It's difficult to find an answer to this question. I think governments or a lot of policymakers the world over have been trying to grapple with this problem of very low savings, and it seems to be very much a Western world problem. So I'm not quite sure what the answer to it is, but I think at the moment it's safe to say, if one looks at the world and you split it up into East and West, it seems that the East has got too much saving, the West has got too much borrowing and spending and a lack of saving. That's the big global imbalance at the moment, and I do think that South Africa lies more towards the Western problem of having too little saving and too much borrowing still and spending.
And of course, it looks like, just looking at the graphs you sent out, it looks like the corporate sector has really been driving the savings rate, or the improvements in the savings rate that we saw last year, Sheshi.
Yes, the corporate sector has done fairly well as far as its improvement in saving. But then again, if you look at the reasons behind that, it's because the corporate sector took a much more defensive position. They decided to withhold dividends. They decided not to hold as much in terms of inventory. They undertook cost-cutting measures. So all those are responses to this difficult economic environment that we were in over the last 2 years.
And those would normalize in an environment where we are starting to see growth coming through?
We would hope so, yes.
You would hope so, but then we are going to have that savings rate drop again.
Yes, I think the savings rate is going to come under pressure again as the economy starts to grow again, and as people start to spend more. Hopefully the corporates will start to invest more, will start to show signs that they are wanting to see this economy move forward. And I think both the savings rate in terms of the corporate sector as well as the household sector will begin to go down.
Well, John, we've had quite a bit of negative news coming out over the past couple of days, really regarding the global economy and prospects for growth. So it doesn't look like we're out of the woods yet. Do you think we're going to see a sustained growth in credit demand in South Africa and in mortgages?
Well, I hope not. When I say I hope not, I hope that household credit growth especially will go slow for quite some time. Now, the May figure was at 3.8%, unchanged from April, and I hope that it continues at that pedestrian pace, below nominal disposable income for the next year or two at least, so that we get a decline, a steady decline in the household debt to disposable income ratio. Because at the moment where we are, the peak in the cycle, the debt to disposable income ratio cycle, was not a crisis at above 80%, but it certainly gave lenders and borrowers alike considerable pain when the interest rates rose a few years ago. And I would suggest that to not get into that painful situation again, we need a substantially lower debt ratio. So a couple of years of slow credit growth, I think, should be seen as a positive, not as a negative. And I think it is going to be relatively slow for quite some time. Lenders are cautious and probably be cautious for quite some time. And I think it's not only about lenders, it's about borrowers too. A lot who have burnt their fingers and are probably going to be going slower through these rather troubled global economic times.
How about property prices though, John? Are we seeing these continuing to tick up nicely? Because that really adds to the wealth effect of South Africans, doesn't it? Makes you feel that you are a little bit richer and you can afford to perhaps spend more or borrow more.
They have been ticking up. In our last house price index for May was 11.9% year on year up. So that's pretty respectable, and it's a reflection of an improvement in demand, largely for primary residential purposes, since early last year. But having said that, I don't see it lasting for much longer, the rising inflation at any rate. I think as the year winds to a close and we head towards 2011, a lack of further interest rate stimulus, a still highly indebted household sector, and possibly some slowdown in economic growth will probably lead it back towards single-digit house price inflation in 2011.
Well, Sheshi, we're talking about the savings rates of Eastern countries just a short while ago, and it's those high savings rates in India and China that's really helps fuel the rapid growth we're seeing in these economies, and that's obviously growth we'd like to see in South Africa. What sort of level of savings is optimal for a country like South Africa?
I'm not sure we can pinpoint a specific number. I think what we need to do is to compare ourselves with our peers, and our peers would be other emerging economies like Chile and Brazil, Mexico.
And we're below all of them, aren't we?
And definitely we're below all of them. Countries like China are sitting at above 50%. India is edging on to 40%. We are in the kind of 15% of GDP gross savings. So definitely we need to do much more, and I agree that the kind of consumer credit-driven growth, structurally we need to do something where growth is driven much more by investment and by saving. I think that's much more sustainable for South Africa and for any emerging economy.
So it's really about not spending what you don't have, John, rather saving and then buying later.
I think that's it. I mean, borrowing has some room to grow in nominal terms, but it needs to grow at a slower rate than income for a while.
Just to close off, what would you expect for this year? Would you expect our savings rates to go back to previous year's levels, Sheshi?
Yes, I think that if the economy continues to show signs of recovery, then the improvement that we saw over the last 2 years, chances are we will lose that. I would like a situation where we are much more vocal about consumer education, about financial literacy, about educating people on the benefits of saving, so that the kind of increase we saw over the last 2 years is not in response to a recession, but it's in response to people actually understanding the benefits of a strong and robust savings culture.
And your outlook for the consumer for the remainder of the year, John?
Well, I think very mediocre. As I've said, I think credit growth has to grow slowly. Banks, lenders are cautious, and I think so they should be in these risky times. So it's a fairly mediocre outlook for me, I think, for our housing market as well. But that's almost essential for a time to get all the big ratios, such as the debt service ratio and the debt to disposable income ratio, and the savings ratio, hopefully back to some respectable levels.